Discounted cash flows are one of the different ways that you can evaluate a business or investment opportunity. You can apply it to common stock, preferred stock, bonds, real estate, even companies. And basically, what you're doing is you're projecting what the future cash flows of the investment are going to be. So it's going to be quite easy if it's a bond because it's probably going to be pretty predictable, or a preferred stock. With a piece of real estate in a company, it obviously it's up to how good your valuation model is of what the future revenues or cash flows are going to be. So you take the net cash flows, which means you take whatever you get minus what you're likely to pay. So cash inflows minus outflows, that'd be the net cash flows. So let's say if I offer to sell someone a building for $1 million, you would estimate that that building would, let's say, earn a net cash flow of 200,000 in 1 year, 250 the following year, and 300 the following year. And what you do is you'd throw those future values in the present value formula, get the individual present values of all those cash flows, and add them up. Once you add them up, you would subtract it minus the cost of the investment, and then that's called net present value. So you take the present value of all those future cash flows that you just calculated, add them up, subtract it minus the cost of the investment. In this case, I'm offering to sell you the building for $1 million. I get what's called the net present value. So of course, if that's positive, that's beneficial. If it's negative, it's not great. If it's zero, it's like right on the nose, right on the money where where you want to be. So you might want to keep a little bit of a buffer in that scenario. So now, in order for me to determine that present value, I have to base it on an interest rate, or what's called a discount rate. So meaning, if, for example, it's what rate I might want to return. So let's say if I want to earn a 10%, and that's going to be on the higher side, that present value is going to be lower because I'm going to be discounting it by more. Now, if that present value is going to be, I'm sorry, if the discount rate is going to be lower, like instead of a 10% and 8%, now those present value is going to be higher, which makes sense because you're discounting it by less or discounting it by more, right? So if you demand a higher rate, those present values are going to appear to be smaller. If you demand a lower rate, those values are going to appear to be larger. Last thing on this topic, there's a concept called the internal rate of return. And what that means is that's the rate that which the net present value equals zero, or the present value of the cash flows is equal to the cost of the investment. So basically, you would almost back into that number to figure out what return. So meaning if I'm offering this building for $1 million, that means that you back into that internal rate of return, and that rate's going to be, let's say, 11%. So at that rate, the $1 million that I'm offering the business for is going to equate to the $1 million of those present value of those cash flows. So I hope that makes sense, and hope you keep listening. Thanks.